Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. So a few episodes ago, I discussed what is called the small cap premium. And that's something that academic researchers discovered that over time, small caps outperform larger stocks. Well, there's another premium that applies to your investment mix, and that is called the value premium. Now, this holds that value stocks return a premium over growth. Again, this is over time, not in any given quarter or year. And one common way to measure that premium is by taking the delta in the price to book ratios between growth and value stocks. Now, if you've been in the market in the past decade or so, you are well aware that growth has been the place to be, but that has changed, hasn't it? Year to date, large cap value indexes have been outperforming large cap growth by a wide margin. So what's the message here? Dump all the growth and go all in with value? No. Despite a lot of investors being confident that they can catch the market shifts as they happen, that's been proven to be impossible, at least on a consistent basis. You might get lucky once in a while, but the task of tilting from growth to value, then back again, is a little more complicated than just saying you'll run to cash in the next downturn and then hope you feel comfortable enough to get back in the next rally. That's also been proven to be very, very difficult to consistently do. Now, in today's interview, these topics of market timing as well as risk tolerance are at center stage, along with the idea of investing in numerous broad asset classes to smooth your rate of return and why beating the market should not be your investing goal. And that's something that I've been saying here for quite some time, by the way. Today, my guest, investment advisor Marc Scudillo, joins the show to discuss the different rides that investors go through depending on the market conditions and what securities they own, and why it's important to evaluate what your specific investment goals are. We also get into the topic of investor psychology, which is something that doesn't get enough attention, in my opinion, but is crucial to a healthy financial future. So you'll want to give a listen to today's interview with Marc Scudillo of Eisner Amper Wealth Management. All right, Marc, the way I've begun every podcast episode for like the past 8 weeks or something is with some version of how should investors be viewing the market now? Because by some measures, we're in an uptrend, but there are still plenty of reasons to believe we could still undercut prior lows. So what's the best way to view this right now?
Yeah, so there are many, many thoughts out there. The market now at a discount, we were in bear market territory not too long ago, and it's very possible that we could hit that again, even go lower and test new lows for the year. Clients really should pull back and say, well, what does that really mean to them along the way here? Because if the money is not really needed in the short term, these are opportunities. When the market has these types of pullbacks, when it's scary to get invested into the market, those have often been the good times to be making additional purchases. And so by looking at this and knowing that there's probably going to continue to be volatility that we're seeing into the future, that's not going to go away. But we have had a long run of positive markets. We were in historical bull markets.
Do you think people got complacent with that, Marc?
Oh, yes. So investing becomes easy when the market just has a one direction that it's going. And where the challenge is now when the markets are turning and you're not paying attention to how it's actually affecting your plan, whether it be your current spending, affecting your future outlook, making sure that you're looking at this in its entirety, because now inflation is kicking in and there's some people that were thinking that just their stock portfolio will alone outpace inflation. Long term, that will happen. But in the short term, this year, that's not necessarily the case.
Right. And I was an advisor myself for many years, and I do know that was sort of many advisors got into autopilot on that, is just invest in equities, that'll outpace inflation. And all of a sudden, those talking points are changing, aren't they?
They are. And when that happens, what behaviorally what we've seen is that we start following and seeing long trends and we get caught up into those trends, right? One of the long trends that we just have seen right now is, growth stocks have outpaced for such a long period of time that everybody said, well, we just need to be getting into growth stocks. If you remember back in the late 90s, we did go through a significant trend. That was that whole technology bubble that we all lived through at that point in time. And everybody said, all you needed to do is buy these certain stocks. And many of those stocks are not even in business any longer.
Right. Pets.com being one of the main punchlines to those jokes, if I recall. That's right. You bring up a good point too, Mark, because I think a lot of people misunderstand the role of growth versus value, and they believe that growth is always going to outpace value. And that's not necessarily the case either, is it?
That is not the case. And actually, when you look at the decades and you compare the various decades through history, there's been a number of decades that value, when combined with all of the growth phases, actually provides for a little bit higher of a rate of return, but even what we feel more importantly, just a smoother rate of return. So you might get to the exact same average over the decades of a rate of return being in growth or being in value, but the highs and lows, the rides that you go through along the way can be significantly different. So think about that from an investor's perspective. They love it when the market's going really high, but they like it even less when the markets are going down, right? So the utility of their happiness of markets and being invested, they really get depressed when the markets go down, like what we've just seen between the FANG stocks and seeing all those stocks take a tremendous hit lately. It hurts a lot more when that happens. So if we could smooth out that rate of return for clients, it just gives their investment experience just a little bit more comfort.
Let me ask you a follow-up on that, which occurred to me as you were speaking. And I think you're right. People don't understand sort of these rates of return, in which cycles they occur. I've talked to people for many years about sequence of returns risk, which is the fact that if you're retiring, say this year, in a year when the market is down, that could put you at particular danger, particularly if you have loaded up on all these growth stocks that have been tanking recently. So that may be another reason why people should be considering other equity asset classes. Would you agree with that?
Absolutely. It's equity asset classes, that diversification concept, even outside of equities, to get the appropriate amount of diversification to smooth out your rate of return. And keep in mind that if your plan is saying that you're going to need a certain amount of cash in the short term, then your exposure to the markets should be limited with that amount of cash in the short term, because anything can happen. And so you really go back to the behavioral side of investors. And what we found is that investors typically have, one of four main, we'll call attributes to how they'd like to invest. They might be those that are more of the performance seekers. They're looking to try to outperform the markets, right? They might have a different asset allocation concept where another might be really seeking to minimize or mitigate the risks on a market downturn. And they might have a different mix of investment strategies, even though they might have the same 60% stock, 40% bond allocation between the performance attribute and the risk attribute. It just might be composed of different types of investments. And others are looking at costs as their main driver. And the fourth is taxes. Some people just hate to pay Uncle Sam an extra dime if they don't have to. So they try to mitigate their taxes within their investment strategies. So those are all different concepts that allows an investor really to stay invested in good times and bad times when they're comfortable and they understand it's going to meet their primary investment attribute.
Right. And I think that's something that maybe people don't think about so much, because I think there's this idea that people have to beat the market. And that's not necessarily right for everybody either, because it's about getting the return they need for retirement. But somehow this idea that it's all been gamified has really caught on. And I find that pretty unfortunate myself.
It is. It makes it challenging. And that gaming concept, call it what it is. It's gaming, right? And so, over a long period of time, those that try to game the system usually have a point in time that they're going to be challenged. And so what we say is, if you could be consistent with the system, but do it potentially with less risk, if you could capture more of the upside of the market when it's going up, but participate less when the market's going down, that's a concept of itself that meets most investors' needs.
Okay, then let's talk some specifics about how to do that, because I understand the advice to stay the course, but I also, and this is again from my experience as an advisor, I know that plenty of people, when I first met them before they became clients, they would have no investment philosophy to begin with, just a collection of stuff. So I think in that case, the advice of stay the course is not really good advice because there's no plan in place to begin with. So how would you advise a person listening to this who is not sure what to do right now in this current market?
So in all markets, even in the positive markets and now in the more challenging markets, we feel that the opportunity to reevaluate first your goals and your plan. What is the money being invested for? What's the purpose of it? That'll give you the ability then to strategize, setting the goals of what you can handle as part of the volatility along the way, the time horizons until you're going to need the money, and then also understanding yourself of what your reactions will be in good times and bad times. We promise all of our clients, we promise you the markets are going to go up. We also promise you the markets are going to go down. And that's just the reality of investing. So we just want to make sure that we're going to meet your goals in both scenarios. And that's our job. And so investors today should really be looking at it saying, well, what are my goals and how do I structure a concept of investing that's going to help me achieve those goals in as many market scenarios as possible? And that might not be just all in one type of equities. We would not recommend that. You get the diversification that you need between equities, bonds. Even though bonds are being challenged, there's still ways of getting exposure to bond-like investments that's going to reduce your volatility inside your portfolio, as well as utilizing other strategies that are out there that might even provide additional stability to the portfolio like bonds. And make sure that when the markets are changing, it's not just simply riding it out. It's riding it out and being proactive to take advantage of the market situation. So one of the things that people should be looking to do is, well, maybe we should be harvesting some of the losses in the portfolio so you can increase your tax efficiency now and into the future and harvest some of those tax losses. And that gives you tax out for a tax performance. Another thing is to make sure that you're reinvesting. And if you could buy into these dips in the markets, these are great opportunities to continually buy lower. If you thought it was a good investment 8 months ago, and now it's down 20%, well, it's now a better investment potentially, so buy more of it if you can. And third is that if you have the ability to also, and if it makes sense according to your goals, is if you could have your stocks pay you rent. That's utilizing dividends along the way there, and you have those dividends being reinvested in the portfolio. They're buying more shares at this point in time at a lower cost. And that's another opportunity, is to have those dividends paying to you and or to your portfolio for reinvesting.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. I like that concept of looking at the dividends as a rent payment. That's kind of a good analogy right there. I like that a lot. Let me follow up on something else you just said too, which is about buying stocks when they're at a lower valuation. Now, there's a lot of advice out there, and I don't necessarily agree with this myself, Mark, but there's a lot of people that are like, well, you don't want to do that because you don't know if the market's going to be at lows yet. It may slip even lower. It doesn't matter because you're still buying the stock off its previous higher valuation, aren't you?
Correct. If there was a way, and if someone could find it, please give me a call and let me know, that you could time the bottom of the market, I'm all in favor of that. Just like if you could time the top of the market. at that exact point in time, I'm all in favor of that.
Would you conference me in on that call when that happens? Thank you. Yeah.
Absolutely, Kate, you're in. We got you covered. So, but the reality is this, is that proper strategies and rebalancing reduces your risks over a longer period of time, allows you to take advantage of the highs in the markets. It's very easy for an investor to feel confident in saying, all right, now if I had just simplistically saying a 50% stock, 50% bond portfolio over the last 5 years, if you did nothing, that stock portfolio would have grown to close to 65, 70% of your portfolio. Now you're taking on more risk. Well, if you rebalanced along the way, stayed consistent to that 50-50 allocation of stocks to bonds, you'd be more protected now when the markets do change. Now that the markets are going down, and now you might have 30 or 40% of your portfolio allocated to stocks, well, now's an opportunity to buy into it to get back up to the 50-50 allocation. It's just, again, the clients, investors, I should say, sometimes feel uncomfortable because they know the market's going down and everyone in the media is going to be selling the concept of how challenging the markets are and it's going to get worse because that's what sells. And I understand that. But start buying into the markets now. It doesn't have to be all of it. Start dollar cost averaging, start rebalancing the portfolio so you could buy into the dips.
Mm-hmm. And, I'm just thinking back on what I've done in the past, and you never remember that. You never go back and remember and say, well, I bought this stock, but it went a little bit lower. When you're dollar cost averaging, you never go back and remember that. You're just happy you had it a few years later because it's risen in price.
What's going on? That's exactly right. So unless you're an actual day trader, which you're trying to trade the stocks, which most investors should not be doing, unless that's their full-time occupation and they're trained properly in doing so, but most are not, then they should be consistent with a strategy that's going to allow them to have a plan that's going to work, like I said, in good times and bad.
So let's switch gears a little bit here, Mark, and talk about some segments of the market that have done well recently, because there are some. It's not a total train wreck out there, is it?
It's not. If you look at the energy sector, you're seeing companies like Exxon and Hess, they're up 50, 60% for the year. Some of the pharmaceutical companies are having positive rates of returns along the way here. This is all part of the diversification. And if you think about it, those are the differences between, those are segments of the markets that if you were fully diversified and you had both growth and value as part of your portfolio, those are the value type typical stocks that are now performing and outperforming the growth stocks. And they have the higher rent checks, i.e. dividends that they're paying out along the way too. So these are all part of why you want to have a strategy that matches up. Don't play the sector bet, because then you might, unless you're looking to hit a home run, which most investors, you have to be willing to strike out then if you're going to try to seek for home run investment strategies. Maintaining that consistency and a diversified strategy is going to play out, and you'd have exposure to companies like this.
Okay, let's follow up on that then, because I think that is sometimes confusing to people, is when we do mention specific sectors or specific companies, and I think sometimes people interpret that as, should I go out and buy this stock? And not necessarily, is it? How should people look at these? Like, say they want to capture returns from energy or pharma right now. What is your advice how they should go about that?
Right. So, if you have cash at hand right now, creating that diversified strategy, which would include still some of these segments of the markets, but it would also include others, such as some of the areas that have not performed as well, such as some of the growth stocks. Your purpose is to get to obtain and maintain the diversification in the portfolio. And that's part of the whole rebalancing strategy. And if you have cash, it's the dollar cost average it over time. We feel strongly about that, and especially in these markets, it helps to prevent a black eye in the short term.
So how do people know whether they're diversified? I mean, I know that there's a popular TV show segment where people say, are you diversified? And it pops up with 5 stocks, and that's not really diversification. What would you suggest if people are wondering whether they're diversified or not? Because my experience is most individual investors really don't know, and that's okay because they're not trained in that.
That's correct. There's systems and tools out there that can help individual investors out there in the marketplace and online. But even there, they might not really understand what they're looking at. Some clients, they feel if they have 8 different mutual funds, as an example, as part of their portfolio, they're diversified just because they have different names and different companies. And they don't have, I'll put in quotes, all their eggs in one basket. But when you look under the hood of saying, well, what's your top holdings within each of those mutual funds, and they're all the same, are you really getting the diversification of all those stocks that you have are all the same stocks within the 8 different mutual funds that you now own? And you're no longer diversified. And you could have made your life a lot more simplistic and not received 8 statements, 8 prospectuses a year, and all this stuff. Just buy one then. But the point is to look for strategies and seek advice that's going to confirm that you have an appropriate amount of diversification that's still based upon your goals, though. Not just saying, I want to invest for the sake of investing, because then you don't know really what you're targeting for, and you're on the road with no map.
Something just occurred to me too, because there are a lot of people, and I understand this. Like I said, I've been in the advisory business myself. There are a lot of people who don't want to hire an advisor to manage their money. But Mark, even if you get a good financial plan and you get that, you check in with your planner once or twice a year, that person can still help you figure out how to diversify on your own if you follow through,
That's
can't they?
correct. If you like to be the person in charge of the actual implementation, there's nothing wrong with that. As long as you have the systems to follow through and keep up with it, and you're using the support mechanisms that are out there, which there are advisors that we provide services that you just looking for guidance at this particular point in time regarding this topic. And we're facilitating that specific review or that need. That's absolutely fine. As long as, again, that you're able to follow through, you're able to take the emotions out of it. So when the markets are doing poorly, that you are rebalancing at the appropriate points in time. And that whole emotion and behavior side really becomes the most challenging part for a lot of people, because that overrides.
It really is. Yeah, it does. And investor psychology is very important. I mean, I've talked to a lot of people who say they have a high risk tolerance. I think for some reason people see that as being more virtuous or something. But then when the markets would tank, like they have been in the past few months, I would get calls from those people saying, we need to go into more cash. And I'm like, well, wait a minute. On your surveys, you answered the question that you had a high risk tolerance. So it's a tricky thing because it changes, doesn't it?
It does, based upon the markets. And that's why we try to isolate the conversations with clients to say, is performance, risk, cost, taxes, which is your main attribute right up front, to determine how you should be strategizing. And with those same clients that say, I want to move to cash now that the market's down, you follow up with the additional question was, okay, so if we do that, when would you like to get back into the market? And the reaction is very consistent. It's, well, when I feel more comfortable or when I see something's changing. And then we often say, well, by the time that happens, the market's already gone back up for you to feel more comfortable to get invested. And you missed it. And you saw that back in 2008 into 9. You saw that again in 2020 for that short period. I mean, fortunately, it was such a quick turnaround that many clients couldn't react to their emotions. And so they were able to avoid that knee-jerk reaction. But it's part of our role is to make sure that we're keeping clients consistent with their game plan in all market situations. And that helps alleviate some of their emotional knee-jerk reactions.
Yeah, very important, because that's exactly right. I think I said this in an episode a few weeks ago, but I recall back in 2009 when the market did go into a rally in March of that year, I was talking to people a year or two later who still were not aware that the market was in rally mode and they missed the whole thing.
And it was a huge upswing right from that point in time going forward. That is correct.
It was. Yeah, you're exactly right. So I think sort of the takeaway here, Mark, is I do and I understand that people have different levels of comfort when it comes to working with a planner or an advisor. But I think the idea of get some assistance, don't try to do this all on your own, have somebody look at your unique situation, because everybody's situation is unique. My situation's not the same as my next door neighbor's, and hers isn't the same as the guy next to her. So it's all very unique, isn't it?
It absolutely is. And listening to the neighbors of what's worked for them, we hear that all the time, and that's not you. And to focus on things that are really in your control, right? I mean, as investors, what are the mechanisms that you really can control are really 5 things. You could control your spending and how much you want to spend on any particular item or your needs. You can control your savings of how much money you're putting away. You could control the risk tolerance that you're willing to take on truly in good times and bad times, challenging times. You could also control the timing of some of the situations, the timing of when you're going to retire, timing of when you're going to buy the house, buy the boat. These are things that are in your control. And then lastly, you can control the amount of legacy that you wish to leave behind. These are elements that you have a direct influence. You can't control the markets. So how do you create strategies that's going to give you the best opportunity to accomplish your goals in all markets? And focus on that which is in your control.
That's a great place to wrap up here, Mark. Really appreciate that. That's excellent food for thought out there, folks. What can you control even when the market is out of your control, which, by the way, it always is. So, what steps can you take to take control of your own financial future? That's great. Hey, Mark, if the listeners want to know more about you and your work, how do they get in touch with you or how do they find you?
Sure. Thank you, Kay. You can reach us right through our website, www.eisner, EISN as in Nancy, ER, Amper, A, M as in Mary, P as in Peter, ER, WM for wealth management, CB for corporate benefits.com. So Eisner, Amper, WMCB.com.
Okay. And that's kind of a lot to remember. So we will link that up in the show notes for sure. So, all right, Mark.
Thank you for asking, Kate.
Yeah, absolutely. Absolutely. And thanks for joining the show today. Really appreciate your insights.
Thank you very much.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.